Net Wealth Investments Limited is licensed to provide general advice. Our podcasts are not tailored to any one financial situation and may contain views of our presenters which may not align with Net Wealth's. The guests' organisation and Net Wealth have an arrangement for their financial products to be available for investment through the Net Wealth platforms, and Net Wealth may receive fees from the guest. More information about Net Wealth can be found on our website, including our financial services guide and disclosure documents. Please seek professional advice before acting.
They wanted to support us, but they also wanted to see us succeed before they really gave us that support.
So we have a very, very strong footprint around about the 12% mark of the professional advisors in the industry today.
I think we can probably do a little bit of work as advisors and advice firms to just sort of simplify things and take a step back, unpack it all.
You have these family office principles. Every generation, eventually, the principle changes.
Hi, and welcome to Between Meetings with Matt Heine. In this podcast series, NetWealth's CEO and Managing Director chats to industry leaders and innovators with local and global expertise. They discuss the latest technologies, business models, and demographic changes, as well as leadership lessons and trends that are impacting financial services. We hope you enjoy their unique insights.
Hi, and welcome to Between Meetings. My name's Matt Heine, and I'm the host today, and delighted to be joined by Professor Lauren Cohen. Lauren is an accomplished academic, writer, editor, and advisor to companies across the US and government. Lauren, rather than working through your resume, I might just hand over to you to give a little bit of background and some of the things that you're interested in.
I am the Ellie Simmons Professor of Business Administration here at the Harvard Business School. And really, I sit in two departments here. So I have a joint appointment in the finance department and the entrepreneurial management department. And so in those two departments, it really kind of exemplifies what my research is about, okay, and what I'm really passionate about. And those are these two areas of behavioral finance and decision-making and innovation and innovation systems. And we'll see how they're going to meld together in some of the topics you just mentioned. But look, I got my training, my formal training at the University of Chicago. And so I did my MBA and my PhD there. And I really had two advisors there. And so one of them was this professor named Eugene Fama. And he won the Nobel Prize for this idea that markets are efficient, okay, market efficiency. So it's the idea that prices are right. If you just see, Tesla's trading at $250, like, lest you think it's $300 or $200, like, cool your jets, okay? $250 is our best guess at what it should be. And if it were supposed to be $200 or $300, then there are people in markets that are highly incentivized to push it to the right price because they could get paid billions of dollars for doing so. So in liquid markets, you have that pressure that's constantly disciplining price. So that's one. On the other side was a professor named Richard Thaler. He won the Nobel Prize a few years afterwards for being like, Fama, totally wrong. Okay. And prices are off. And the reason they're off is that people make mistakes when they make decisions. There's these whole fields of psychology and sociology thinking through decision-making for centuries, and they've documented all these mistakes people make. If they make them in financial decisions as well, then maybe they can enter the prices. So really, my area of expertise is in blending these two together, and I'm one of the world's experts in thinking through where prices deviate from fundamental value, why they do that, and what causes them to converge back. And so that's one line. The other line is in innovation. And so I've been lucky to work with the USPTO and patent and trademark offices around the world and with governments in thinking through how to create sustainable economic and innovation systems and threats to those innovation systems, right? What's really kind of coming in at the borders to push that away from where we would like it to be. And so those kind of really have blended together to kind of blossom into those areas you talked about. So family programs and family offices, which I'm involved with here at the Harvard Business School, along with fintech. So I created and I teach the Harvard X fintech course here. They bring in all of these different elements into this kind of wonderful environment of both innovation and then on the family office side, really the fastest growing organizational form throughout the world. And that is family offices, right? They're faster growing than VCs, faster growing than PE, like you name it, they are exploding. They're becoming more important in every part of financial life, and really philanthropy and also intergovernmental organizations like the UN and the World Bank are also teaming with them. And so I think the role of family offices, we're just starting to understand that, and we're going to see that evolve and become even more integrated over the coming decades.
I'd love to dig into your thoughts on family office, but before we do that, hearing from those two as you were sort of working through and identifying your own philosophy on how pricing works must have been absolutely fascinating. You could not ask for two more diametrically opposed views on the topic. And I imagine it might be quite difficult to actually synthesize it over time. As you sort of look forward, have you come to the conclusion that one is more important than other, or is it really dependent on a range of factors that are really quite difficult to codify?
The beautiful part of them, Matt, and it's a great question, is that you really need some foundation in both to understand, and to understand that kind of true value from both. Because if you think about it, look, there is no outperformance or underperformance if you don't have a benchmark, right? If I say, hey, Matt, is that hot? You're like, well, I don't know. Compared to what? Right? Like you would need to know relative to something. And so in that sense, it's really that kind of traditional and rational framework that provides such a powerful benchmark, and it really provides a framework that fits lots of situations. So things like there are law of one price. I'll give you an example. There's the law of one price. So what the law of one price is, a beautiful, beautiful edict. It essentially says that, hey, look, you can't have two identical goods trading in the same market for different prices. It can't exist. And again, if we live in this frictionless world and milk is selling for $3 in one place and $1 in another place, that's an easy one, right? Everybody and their uncle is going to go buy the milk for $1 and sell it for $2.99 and then $2.98 and then $2.97. And they'll keep doing that until those prices converge. And so that arbitrage alone, markets, that invisible hand alone is going to push prices such that those arbitrage opportunities, if they're there for a second, right? And then people push them back down. And so it's those kind of things that I think are powerful disciplining device on markets. And they kind of describe a lot of the way the world works. But the thing is, these behavioral factors seep their way in, and they seep their way in really powerful ways that aggregate up to sometimes push prices and even entire industries and countries and markets off of that fundamental path. And so it's not just that it's one price of one weird stock like pets.com for a little bit of time. It can push entire markets up for quite a long period of time. And so that's what I think is so powerful about it. But to understand where it's pushing it up and why, you have to understand where it should be in the first place. And so I think that understanding those two is really the fundamental to pulling out the powerful.
And when it comes to supply and demand, we're going a little off topic here. Clearly, a lot of variables, and your product example is a really good one. If I think about the dynamics in the Australian financial advice market at the moment, there's a huge supply and demand imbalance. So we've got millions of Australians looking for advice and only 10 or 11,000 advisors that are able to deliver that advice. And yet, if anything, the price is actually going the wrong way and it's going down, where consumers are demanding more for less. And we haven't actually seen that revert to a normal scenario. What, with limited information, would you sort of try and explain that away with?
Clearly, there's some friction there. Those could be information frictions. They could be search friction. So, which is to say, like, hey, look, maybe the advisors have really awesome advice. It's just people don't understand how awesome that advice is. So they just sit at home and be like, God, I wish I had somebody to give me great advice. And they don't realize that it's literally like one door down. There's someone who can give you awesome advice. And the problem when you have information asymmetries like that, so you have the financial advisor that's the expert, and then other people who are seeking that expertise, is that it's actually really hard to assess expertise by definition if I'm not the expert. It's like, how do I know who a great doctor is? I'm going to go, they have the expertise. So if I go in and they're like, you need surgery, I'm like, well, I don't know if I do need surgery, but how am I, I need to take your word for it. And somehow you need to build up that trust. So somehow it could be just an information gap in terms of what great information is out there relative to what people want. It could be that the advisors themselves aren't delivering it in a way that are compelling to people. And if that's true, then that's on them. They need to somehow package that in a way that people want, or put it in a market that people want, right? Maybe people want them in short TikTok clips. That's how they want to get their financial advice. And the advisors just haven't gone down that path yet, right? They're still writing like longhand letters and attaching them to pigeons to get to their clients when that's no longer where demand is. So it could be in that delivery mechanism, or there could be something else fundamentally going on, right? In that, hey, look, what's really going on here is that somehow there is some issue in this market where we can't measure things correctly, and then we can't convey things correctly, right? And that in the financial advice market, that is a really tough part of this, is that, look, financial advisors advise for the next 30 years, 40 years, maybe intergenerationally. That's a really hard problem and a really long time to get somebody to take your word for it. Oh, believe me, Matt, this is going to be in your best interest. Let's just wait 40 years. And believe me, I'm going to be right. Hey, he'll be like, well, I'm not waiting 40 days. Forget about 40 years. And then if there's some kind of negative short run shock, which happens in markets, there's an inherent volatility in all markets, then it causes people to pull back, and then it reinforces their initial beliefs anyway, where they were hesitant to use these advisors.
And I know that you've advised to a number of very successful fintechs in the US. And is it that information arbitrage or value gap that you're really exploiting when it comes to technology, or is it more around the user experience and accessibility that's leading to that almost separation between those that are going to use an online service versus a traditional?
Look, I think this is a great question. And I think probably the best exemplar that I have to really key in on exactly this is the insurtech industry in the US. And so I'll kind of tell you how that evolved. And so I was working with the head of innovation at one of the, think of these old traditional insurers, one of the largest ones in the US. And really, the insurance model in the US has traditionally, like in many other countries, has been built on trust, like many other aspects within the financial market, right? Like many other kind of sublines. And in fact, if you look at even the mottos of some of these old line insurers, there are things like a good neighbor, State Farm is there, right? State Farm is one of these big ones, or like Prudential is a rock, that's going to be there. You can trust, we're right beside you. And each one of these models had these distributed agent models where you would have someone in your neighborhood, right? Susie would be your insurance agent, but you'd also go to Little League with Susie, and you go to barbecues with Susie, and you would know her, right? That's why you trust and got your insurance. Some of these entrants came along. I'll give you a few examples. Some of these names are Lemonade, Ladder, a few of these others, Hippo, that have come in, and they completely upended that model, which is they said, hey, look, we're going to be a total tech-based platform. And so you're only going to deal with us through our app, right? And through these tech platforms. And instead of us coming out and helping you to price it, you're just going to take pictures of it and we can assess it from there. And then we can, take videos of your home and we can get a feel for what the insurance price should be, and we can get from public records. And so it turns out that, what people really don't like in insurance?
Right.
People. They don't like other people. They'd much rather just deal with their phone than have to wait for Susie to come over to tell them how much the crash is going to cost. I think they really tapped into something that just even people didn't know they didn't like in insurance. And so they really innovated the business model. Now, what's so interesting about that is that you can actually read these in their financial statements. They also do publish their loss models and how much loss they've made in the actual insurer itself. So think of the actual the tech. They claim to have some tech around assessing loss rates and these types of things with all of these new boundary technologies they had. That turned out to be totally untrue. So their loss rates, if anything, were at the level or worse than the traditional insurers. So insurers were insuring better, doing the thing that they had to do better than these insurtechs, and yet insurtechs were eating their lunch. And the reason is that the UI and UX were so attractive, and that new business model was so attractive to consumers that was enough to upend this market, right? That they were kind of okay with them being worse insurers and giving them worse pricing. And so the insurers thought that it was pricing and the neighborhood insurance that they want, right? Susie right beside them. And it turns out none of those were true, right? What they really wanted is just quick, easy, and painless access.
You could suggest that that's a generational shift or change, but I'm sure you're going to tell me otherwise. What was the evidence about the type of people that were adopting or using that technology? Was it actually young adults, or was that a complete myth?
Yeah, no, so you have the exact right intuition, right? But here's what makes it hard to figure out and to really disentangle that. So you are right. Like if you look at the penetration rates, they're much higher as you go down the age distribution, right? So the younger people are using this much more than people later on. What always makes it hard in inferencing those problems is that if we're learning anything from this kind of decision-making, so decision-making is looking at change and what causes people to change their mind and change behavior. You can think about it. You know what the biggest drivers of change in behavior are? Nothing. You never change your behavior ever, okay? To a first order approximation, you will do the exact same thing today that you did yesterday and the day before. I can guess what toothpaste you use, Matt. It's the same one you used last week and the same one you used before that. I can guess the way you go to work because it's the same one you went yesterday, the day before that. I can guess where you put your yogurt in the fridge. I can guess so much about you because humans in general, we get into patterns, and those patterns of behavior, we stick with them. We stick in those ruts and we don't like to change. And it actually causes quite big shocks for us to change. You can think about you having to move to a new house, right? Or your toothpaste being discontinued or something like that, you actually have to change these things. And so given that, a lot of these, of the people in the older generation have just always bought insurance in a given way, and they have no shock that causes them to change. And so that's why it's hard to tell whether the penetration rates would be different if they were de novo to just all separate from their insurers and then everyone had to choose a new insurer again. But there's so few times in life where that happens, right? Where de novo, you're forced to separate, and then you have to resolve. That a lot of times that inertia in behavior really drives a lot of the things that even we think look like active choices.
So that potentially puts quite a lot of pressure on current financial planning models around the world. I think everyone probably recognizes that there is a change in which is occurring, but maybe not at the rate that it could happen. But if you're looking to service digital natives or that next generation's coming through, I think that's when we might see that next big wave of innovation and adoption, particularly in financial advice, because certainly in Australia, it's been very slow or non-existent.
I think you could be exactly right on that, Matt. I think that you may see that. And I don't know how many advisors you know that are trying to bifurcate the age distribution, which is they're either offering different services or offering services in a different way to different parts of that age distribution.
Yeah, I think that's a brilliant example. Maybe off the top of your head, from a market share perspective, do you know how successful those insurtech firms have been over the last 5 years? Is it starting to really gather pace, or is it still very much in its infancy?
Yeah, I mean, they really are gathering pace, right? To the point where they are growing much faster than the traditional insurers, which may not be surprising. They're smaller to begin with. But they're getting enough of the market share that what has happened is that these traditional insurers are trying to innovate their way to a product that competes with them. Now, as we know, that's hard as the traditional insurer for lots of reasons, right? The same reason that we put our yogurt in the same place in the fridge is the reason they do things the same way, right? They have legacy systems. They have these distribution models in place where agents are an important part of their workforce. They now have to tell them, hey, look, agents, we're going to do things differently. And that might mean not as many of you as jobs. That might mean your job looks very different. And these are kinds of things that are hard to push through large and established workforces.
What advice would you have for small firms, large firms, or even institutions that might be listening to this podcast about creating or changing that mindset to more of a growth mindset and innovation mindset? Because to your point, change is difficult and people don't like change, and yet it's going to be critical as we go through this next wave of disruption.
I think that's a great and a hard question to solve. And I think in some ways, the solution is firm specific. And so changes firm by firm. But I'll give you some general guidelines, right, that I've seen, at least in the firms that I've dealt with, things that have worked well and kind of general rules of thumb that have worked well. And that is this. Many firms, when they think about innovating in their product, they think about replacing one product with another. So this Nobel Prize in economics that was just given, right, one of the big contributions of the three economists who got it was in helping us to think through the way creative destruction works. Or in other words, the way that a new product comes in and completely usurps an old product, so it destroys what had already existed, but it creates something newer and even bigger and potentially better, right? And so things like, mechanized farming, right? If you can think about before mechanized farming, it was humans who did most of the farming, right? With the help of animals and some other things, but essentially mechanized farming displaced the entire way that we farm, right? And you could say, oh my gosh, look at all the jobs that will be lost. But the benefit is that we can now feed much larger populations than we ever could before, right? We can now feed every human being on Earth and then some. Look, we don't distribute the food correctly. We can, we can certainly debate about that, but we can actually produce enough food. And it's because of that creation of these technologies that allowed us to do that much more efficiently. And so a lot of people think about that when they think of innovation, that, oh my gosh, what we have to do is like a wholesale, so like throw out everything and bring something else new in. But that's not what innovation needs to be at all, right? Innovation can be very small around the edges, right? It's just literally delivering a product a little bit differently. And I'm going to give you an example of exactly this with furniture, custom furniture, and you'll see what I mean. So an example from a furniture company in Chicago. And essentially they did custom furniture there, and think of like boutique custom furniture. And it was like a really slick shop. Okay, man, you would come in, and like you could spend hours just designing your own furniture and a couch and the sofa to look it would be just yours and look just like you wanted. So people would come in for hours, design their perfect couch or seat, and then they leave and they wouldn't buy it. And they thought to themselves, God, I wonder why people are interested. They're coming into the store, but they're not buying, right? They're not doing the end purchase. What do we need to do? I get it. We need to decrease prices. So they tightened their belts and they figured out a way that they could decrease prices. No effect. So they said, okay, I know what we're going to do. We need more colors, more styles, more, threads, more different kinds of things. They did that, increased that. People spent more time there because they had more to play with, and nobody bought. Finally, they surveyed people and they said, look, we see you coming in, Matt. You clearly are enjoying this and like creating your own couch. Why aren't you buying this? And here's the response. He said, look, Lauren, I would love to buy this couch. Here's my problem. I already have a couch and I don't know how to get rid of mine. I'm on a 4th floor walk up, like, well, how the hell do I get rid of this big couch? You know what I mean? A small staircase and hallways. And so they said, okay, that's it. That's the problem. And so they implemented an innovation. Their innovation was, hey, we'll get rid of your couch. Done. You don't have to do anything. Your hands are clean. You buy one of our couches, we take care of everything else. That innovation, sales jumped 40%. You could see the innovation was around how they delivered this product. It wasn't a wholesale reconstruction of everything they did, but just that one thing around the edges, and it caused a massive increase in sales. Those kinds of innovations, they're there, right? They're there in space, ready to be grabbed up. People think of it as a marathon, and it's much more like a 5K.
So I think that sort of brings innovation really back to its absolute core, which is you need to understand the customer and really understand what the customer's problems are before any of it can even be put in place.
I think that's exactly right. And it gets back to the example you talked about before with that supply-demand imbalance in Australia. And I would be intrigued to know what you think the attributes are that are being misaligned.
Absolutely. And I think it comes down to the value gap and people not broadly understanding what the value is that can actually be delivered and what the outcomes are that they might likely expect. And there's a whole range of reasons for that, particularly, some negative press over the last, 5 or so years, trying to rebuild the perception of what advice is and what it can do for you, I think is the real challenge. But regardless, in the event that more clients are actually looking for advice, there's not enough advisors. So we do need to start to look for more innovative solutions, leverage technology better, and find ways to support advice through digital means. That's a big challenge, I think, for everyone over here.
I mean, that makes complete sense. Have you seen movements in that direction?
Slowly. I think the industry, we're very regulated, but equally because there is so much new business, profits are growing and growth is high. It's more out of necessity rather than innovation. And so we're not necessarily seeing that sort of step change in customer service or value proposition that we might expect to have occurred.
Imagine a world where wealth technology is simplified. NetWealth is continually investing in new tools and platform features to optimize your staff productivity and to give you and your clients the best user experience. With our managed accounts functionality, bring new efficiency and scale to your investment operations. A world of technology awaits. Discover it at netwealth.com.au/woo.
I'd love to hear from you what some of the most interesting wealth management innovation or technology is in the US and where you're seeing the success at the moment.
I'm happy to jump into those. Before I do, because you mentioned this, and we're seeing this in the U.S. market as well. And really, we're seeing this as a global phenomenon. So I find it to be quite interesting from a wealth management perspective. This is no surprise that we're seeing concentration of wealth, right? And so we're seeing, in much the same way we're seeing within industries, that the biggest firms are getting relatively bigger, relative to smaller ones, so getting higher market share. We're kind of seeing the same thing with wealth, right? So we're seeing wealth is rising everywhere. But in particular, amongst these highest income percentiles, they're getting even more wealthy. And interestingly, even older. And so we're seeing that the wealthiest become older and wealthier. What is that doing? Well, that's changing the entire wealth management landscape. Because then you might think about as a financial advisor, although frankly, philanthropies are facing the same problem, that their donor bases, they are setting records in terms of the amount of donations they get, but they're scared out of their wits. And the reason they're scared is that they're getting it from fewer and fewer donors. So the dollars are going up, but the number of donors are going down. So they're relying on a smaller and smaller set of just, very generous people, but they are aging. And so we kind of see some similar things within the wealth management industry is that these are high profit in terms of customers. So that's great. And in fact, profits may be growing and they may be becoming more profitable because you have more and more services you can provide. But the problem is it's to fewer and fewer of these higher concentrated wealth individuals.
I sit on a number of not-for-profit boards and also work with a number of high net worth firms dealing in that space exactly. And I think you've described it beautifully, which is the donor base is getting older and much smaller. And engaging with that next generation is a challenge for everyone. Not only is it more difficult, there's a lot of competing charitable foundations and causes, but the amounts are much smaller. So trying to reach that next generation of donors is a huge challenge. What are some of the strategies that you're seeing charities in the US roll out or try?
And so what makes this so hard, and well, I'll tell you what they're doing, and I'll tell you what makes it so hard, is that it's for that exact reason that they are a little bit kind of looking left and right, because they're like, well, gosh, let's say we were to do all our campaigns on TikTok. Then we lose out on everyone above the age of 80, let's say, which is our big donor base, right? They're the ones who've been giving for many years, and they're the ones who are concentratingly giving more and more, and they don't want the information through TikTok. And so in some ways, the way we might strategize to reach that next generation will upend the way we reach the actual generation that are giving us money. And so in that sense, we don't want to take that strategy. And so what they've been trying to do, some more successfully than others, is of course continue to develop the current contacts that they have, right? Which those are usually higher touch and a little bit more traditional channels of getting philanthropy. And this is impact investing and some other, related channels as well. And then for the younger generation, they've been trying to reach out through some of these other channels. But I'll be honest with you, Matt, there has not been a successful recipe that I've seen yet. So I've seen a lot of attempts at it, but I can't say that, okay, yeah, this has been working tried and true across a number of different firms. And so that is a problem, I think, that is yet to be solved.
And as you say, the concentration risk. So that next generation has got their own issues that they're working through. They've got mortgages. They've got children going through private schools, and making donations or contributing to charitable foundations is probably the last thing on their list. In the same way that a lot of the advisors' clients are getting older, and there's almost a generational gap between their current and future client.
Yes. Yeah, I think that's right. And look, I've heard this, from a number of the families that I've worked with, is that they say, it almost, in some ways, it puts the financial advisor or the wealth advisor or even some of these, family office principals, right? And when you think about that, these family office, so you have the family office principals, and then you have the agents, right? The people working there. So this might be the CIO or the CEO of the family office. They are in an awkward position because the principal is going to change, right? Every generation, eventually, the principal changes, right? So you see this going on. I have a case that I just wrote, Matt, on the Murdoch family and the Murdoch saga that's going on, right? Eventually, Rupert will be gone, and he's going to be out of the picture. So then you have that next generation. And now I guess it's becoming a little clearer anyway that for the moment, Lachlan is going to be the leader. They don't know. And especially when two of them are alive, two generations are alive, the financial advisor and then the CIO of the family office says, well, my gosh, I don't know. That is my main advisor, the person, the main principal that I want to make sure that we're pushing forward and getting their desires kind of fulfilled. But I do understand that if I were to look at the next 40 years, probably it's only another 5 with this person, then the next 35 with this other person. So I also want to be on that balance beam where I don't want to completely contrast with this other person if I think the next 35 years will be driven by them. And so that is a very hard interpersonal problem to kind of straddle. And technology doesn't help you with that.
Yeah, and I think the statistics again support that in Australia, which is 70% of the children of current clients actually change advisors. And there's a whole variety of reasons for that. And again, not sure if you're seeing any smart strategies or ways that firms in the US are dealing with that, because I'm sure that it's a very similar situation.
Yes, yeah, it's exactly the same. And in fact, I was presenting an alumni reunion where one of the families said exactly the same thing. They said, gosh, my family had been using this certain bank in the U.S. for the longest time. And then the advisor who had been with my parents for now, over 20 years, right now, 20, 30 years, comes to us and says, what do you want to do next? And honestly, we were like, are you kidding me? You're our parents' advisor, you're not our advisor. And so they were actively looking at other banks. They said, we don't know you. You've been with our parents. We would be playing in the living room when you guys will be talking. So it's exactly what you're talking about there, right? And it highlights really this tricky role that financial advisors play, in that they want to plan for the long term, but sometimes the long term isn't there, right? If they're like, gosh, well, my horizon is only 12 years with you, So I want that 12 years to be the best instead of maybe thinking about 40 years or 60 years as they'd want to.
So family office is obviously a topic you're very passionate about. There's a saying over here that once you've seen one family office, you've seen one family office. And they are all incredibly different. What are some of the sort of the macro trends or observations at the moment from the US family office market?
So that family, thank goodness, that travels across borders. I hear that quite a lot. And look, in some ways I love it, right? And it's a wonderful description of the space. And in some ways, I think it doesn't do justice to the commonalities across families. And so I'll tell you, one of the real spearheading and foundational pieces that we built here at the Harvard Business School around these family programs is just kind of seeing those things which, gosh, we are seeing in families from Vietnam and from Brazil and from the US and Australia and, you name it. There are these common characteristics. And it turns out there's a lot more in common amongst families than that's different amongst them. So they might have a different organizational structure, and they might have one more kooky cousin in my family than your family, but it turns out a lot of the desires are the same. And so a lot of the solutions, or at least solution guidelines, can look the same and kind of best practices. But to your point, the tricky part up to this point is that they haven't really been codified. And the reason they haven't been codified is I would put them akin to, think about like private equity firms in maybe the late 90s or early 2000s. Back then, you could have said the same thing about PE firms. If you've seen one PE firm, you've seen one PE firm, because they were all different. This one had 3 people that just left the bank. These one were just doing it part-time. These ones were doing this, right? There was just, everyone was its own little pod and space, and they didn't really ever get together, so know what they were doing. And so it was all just kind of these hit miss type organizations. And they've developed into a real thing. Like private equity is a real thing now, right? It's much more institutionalized, and we now have kind of code books of how we do it. And in some ways, family offices are starting to get on that track, which I think is really promising. And so let me throw out some statistics here. At the end of 2024, $4.5 trillion. That was the global AUM managed by hedge funds. Okay, 4.1 trillion. Compare that to family offices, 3.1 trillion. Right? So it's remarkable. So now like 2/3 the size. Right now we're getting to, right, and family offices are growing faster than hedge fund capital as a whole, right? So family offices are growing. Now look, there's a little double counting because family offices hold some hedge funds, they hold private offices too, but the point is they're growing at an incredibly quick speed. And so they're really kind of figuring out what it means to be a family office, what that organizational form means. And in some ways, the really kind of interesting part of family offices and why some of my students, Matt, they will spurn jobs at hedge funds, private equity firms, KKR, Blackstone, to go to a family office is because family office offers much more flexibility, right, in what you get to do, what experiences you get, and it provides, in some ways, a more steep career path, right, in a positive way, a more positively steep career path. Because if you go today, if one of my MBA students were to go to maybe Blackstone or KKR, if their boss is an MBA from HBS, let's just say the same place, from 4 years ago, okay, so they come out this year, 2026, there's an MBA 2022, then they're going to always have that glass ceiling there, right? That person's not that much older than them, but they're always going to be just a little bit ahead of them in their organization. They're always going to be looking up and being like, God, I can't believe we're always under this person. Whereas if you go to a family office, you're oftentimes sourcing your own deals, right? You're having your own book. You get experience that's really unmatched to any other place. And then you get to do a lot. You get to do early stage VC. You might do some seed investing. So you get to try to interact that with their real estate and other holdings in the opco, the operating company. And so you just get to do a lot of things you wouldn't get to do other places. And that's really valuable, especially at early stages of careers. But some of these MBAs are deciding they want to stay there long term with these families because they really build great relationships with them. And so I think as you start to see that evolve, you're going to see family offices become more known structures and in some ways become less of one family office as one family office.
For the purpose of your studies and your research, how do you define a family office? What are the key attributes?
You hit on another very tricky but a very interesting question. And that is one of the really neat and powerful parts about family offices is, and this is worth talking about because it's an important attribute, Matt, is that they are not regulated the same way as other financial institutions, right? These are only usually just that family's capital. You'll get some MFOs. And what I mean here, multifamily offices. What I mean there is a true multifamily offices, right? Which is that your family and my family will get together and pool assets. Many multifamily offices will essentially just be large wealth managers, would call themselves a multifamily office. I mean here strictly two families that pull their assets together. And in those cases, you don't have to have the onerous regulating issues that other types of financial institutions have, right? And so think about a PE firm or VC. They have lots of different regulations that they need to abide by. But if it's just your money, right, then regulatory authorities from around the world are like, yeah, that's fine. If you want to burn it for heat, I don't care. If you want to fish with it off of the pier, like, go ahead, it's your money. And so in that sense, there's a lot more flexibility. They get to do a lot cooler things. They can be more nimble. That's why we see family offices funding a lot of the really early stage and boundary developments. That's true in fintech. If you look at early AI investors, they're family offices. You can see Elon Musk there. You can see Sergey Brin. You can see other of these founders really kind of pushing forward the frontier there. You see it in cryptography. You see it in lots of different places within fintech because they're flexible, right? They can do it. They can invest early. They can invest in different sidecars. They can do kinds of things other financial institutions can't. And when you have that, that's a superpower in financial markets, right? When you have one hand tied behind your back, and I don't because I'm a family office, I'm going to beat you to the deal, or I'm going to provide better terms, or I'm going to go places you can't. And so as these family offices get bigger, I think you're going to see them as being more and more important equity partners in lots of these really boundary and frontier technologies.
And when you think about the most successful family offices that you've worked with, the two key areas, I guess, are really around that sort of family dynamic, succession, legacy. And then there's the actual investment process, whether you insource, outsource, multi-bank, how you manage that sort of governance side of things. I'd love to get your observations on both.
You know what? Let me give it on the investment side first. And so I'll give you kind of two of the biggest mistakes that they make. Okay, they're really kind of related. And the reason I want to mention this mistake is because you are likely making this mistake too, Matt. And I think if you would admit it, I will even admit that I try to discipline myself, especially because I know it's there, but I find myself doing the same. And that is cash management. And what I mean by cash management on their side, and I'm sure you see this with lots of your clients too, is that they just hold far too much cash, right? Which is to say, this is cash that they don't need it for next month. They don't need it for 6 months from now or even 6 years from now, but it's just sitting there. Especially because a large part of their portfolio, large enough, is liquid anyway, so they could kind of turn it into cash within a very short period of time. And yet they just have all of these things in cash or cash-like securities. And so that's a big mistake of a lot of these families, is that they're not using that capital to create a return and just to create capital to do all the awesome stuff they want to do, right? If they want to do philanthropy, if they want to do impact investing, if they want to fund their own family startups or other interesting spaces, or they're worried about healthcare or their communities, like they could be creating more capital to do that, and they're not. And the fact that they're not is just because it's essentially locked away in a basement somewhere, right? That's essentially the equivalent of that. And so that cash management is one of the biggest mistakes that I see families.
And is that lazy cash management, or is that more so that they've built an asset throughout their lifetime, worked hard, and want to ensure that it's from a security perspective, they've always got something put aside?
Well, look, I'll tell you this, and this, I haven't run the statistics on, so this is going to be a little bit anecdotal, but this might be there in the data. And that is that I do see this a lot with G1s, right? The founders themselves. You could completely see where this happens, right? Because these founders, they're true entrepreneurs, right? And as we know, like, look, the statistics around entrepreneurship are fairly eye-opening. And I don't think a lot of people know, right? So most startups fail, okay? And by most, I mean on this order, right? Like, we're talking roughly like by year 5, 50% of startups are gone. Okay, by year 10, we're now talking like 70 to 90% of startups are gone, just completely dead. By year 20, we're on the order of now like 98 to 99%. So if you can have a firm that lasts 20 years, then you are in rarefied air, right? That is incredibly hard to do. You're almost sure to fail as a firm. Now, some of these firms have been around 40 years, 60 years, 80 years, but the probability that happens is bananas. And so all of these entrepreneurs, all of them to the person, if you ask them, God, did you ever have a time that was really rocky and you weren't sure if you'd make it?
Sure.
And I say, buddy, sit down. There were times when I couldn't rub together 2 nickels. where we didn't know how we were going to pay the electricity bill, where I remortgaged my house. I did everything I could. You know what was the biggest milestone that they hoped for? Zero. Zero was awesome, because a zero net income means you paid everyone. Zero net income is actually beautiful, right? That means I paid my employees, I paid my debtors, I paid everyone else off. I don't owe anyone anything. And if they could get to zero, that was like the most beautiful day of their life when they can get back to zero. Then when they start to get above zero, that's like amazing. Like, oh my God, what do I even do with above zero? I didn't know numbers went above zero on the bottom line, right? And so it's just so new and amazing to them. And what they do is that they're entrepreneurs. They're focused on their ice cream business, or they're focused on their motor oil business or tires, whatever they have. So this is what they end up doing once they start generating that capital. They do this. They just throw it over their shoulder. They're like, look, I'm in the motor oil business. I don't know what to do with this. Just put it in our treasury, put it in our cash. And so they build up these cash piles, and that mindset kind of follows them through. They're like, we may have a day when we need this, right? Who knows? The economy may go down, or one of the factories may have an issue, one of these things. And so they kind of take that mindset. So I think that precautionary saving mindset and that memory that was imprinted on them of those days when they were below zero and they kind of didn't know how they were going to make the next month, I think that still weighs heavily on them. And so I think that's part of the reason why they keep so much in these precautionary savings.
And as an advisor, how do you help change that mindset? Because it's totally understandable. And is it a matter of just progressively building the education and the capability of the family office so they do take more risk, or is there more to it than that?
It's a great question. And so I think what is so hard about this is that in some ways I try to show these families the math around this. And so the math is this. I have a case about this family in Japan. Okay, it's a wonderful family, the Kurokawa family. And the current leader is G18. So this is a 500-year-old firm in Japan that's been handed from generation to generation, carefully handed for 18 generations, right? And the current leader is wonderful. He's Mitsuharu Kurokawa, and he essentially is 35-year-old, like absolutely fantastic, comes into my class, he wows the students, and it is amazing to see that kind of family legacy being passed on. And when we start to do the math for the students, I say, look, let's say that here's the way, by the way, that is passed on in Japan, which is very different than any other country, which is that every generation in Australia, in the US, in Europe, in South America, here's how you figure out inheritance, right? It's very simple. You take the number of kids you have and you divide by n, right? Divide by that number. You have 3 kids, I divide it all by 3. I got 5 kids, I divide it all by 5. Very easy. And it turns out that is the easy answer, okay? That is the, hey, look, I don't want to put too much thought into it answer. That is the, hey, it's a commercial break from my favorite show and I want the solution answer. But that's almost never the right answer. That almost never optimizes anything. It doesn't optimize if that the business or that the wealth or whatever you want to do will make its biggest impact in the long run. Japan, they do it differently. They choose one. They choose a single heir, a single successor. And they say, okay, look, everyone else, you can be a dentist, you can be a lawyer, but you can't be Taraya. You can't be this firm. You can't be that one firm. We're only going to hand it on to one of our children. And so every generation, just one is chosen. And only through that line will the company go.
Is it always the oldest, or is it based on merit?
I'll tell you this. So it's often the oldest, but it's not always the oldest. And they sometimes even choose, there's this, they have adult adoptions in Japan. They actually make up a surprisingly large percentage of all adoptions are adult adoptions. And sometimes that's when they don't have a suitable heir, then you can adopt someone in and say, okay, hey, Matt, do you want to be a Nissan? To be the CEO of Nissan? You're like, yeah, I want to be CEO of Nissan. I'll be a Nissan. I'm not tied to my last name. I'll take on anything. And so you see even that happening. So they'll bring in these outside heirs. But so here's the interesting fact about that, Matt. I want to kind of square the circle on this, that it turns out if I were to ask you where the most 100-year-old firms are, you might have to guess a little bit. You think about countries that have been around a long time. Turns out it's Japan. 44% of 100-plus-year-old firms are in Japan. 66% of 200-plus-year-old firms are in Japan. And so think about that for a second. Japan's not a huge country. And yet, if there was someone walking down the street and they were to say, oh, I'm part of a family firm that's 243 years old, and you're to be like, you're from Japan, you'd be right 2 out of every 3 times. That's all they said. You'd be right 2 out of every 3 times. And so what's true is they have a different model and they have these incredibly long-lived firms. Look, can I say that they're causally related? No, they're correlated, but gosh, it does seem like they're pretty strongly statistically related in the data. And so I will do this exercise where I say, okay, look, let's take those 18 generations of the Kurokawas. Assume they each had 3 kids and assume we split it equally like every other country does. Then it turns out that you can take that, you can keep going to the third power of that, right? We can do that. 3, 9, 27, 81, you keep going. And it turns out if you were to do that, you would get like roughly 125 million today, Kurokawas, that you would have to pay dividend payments to if you were to keep that. The current population of Japan at the time that we had this, 120 million. So it would be all of Japan, and you would have to import like 4 million more people in order to pay these people out. Like, it just shows you how quickly families grow. And the reason that's so important is that if you want your wealth to grow too, you can't keep money on the sidelines. Not only can you not keep it in cash, but one other big mistake that families make is they're often too conservative. Like, it's totally fine if you want to be conservative, but understand that that's really going to hamper how this money grows. And in nearly no family's case, is that how they grew the money in the first place. Like, at some point in your life, you had an entrepreneur that put it all in, right? That's like, God, I know the numbers are against us. I know the odds are, but we're going to put it in. And that's how you were able to create this, pot of wealth now that you can use, again, for whatever impacts you want to make on the world.
And so in Japan, what is the responsibility of the heir, if you like, to support the family, manage the legacy, install the values in the broader network, or is it literally passed to one family?
The way that my impression of how this works, and I've seen it now in a number of families, is that, again, it really does work through that family. And so the other families, again, they can be quite successful and they can start their own ventures and do other things. But once that family branch has moved away, then it's away. Right? There are no more claims on the family. It's not like you have shadow equity stakes or anything like that. No. It's gone. Right? You have now moved to a different branch that's no longer connected to that operating company.
Lauren, conscious that we are now unfortunately very short on time, it would be remiss not to ask you about your thoughts on AI and where that's heading in the next 5 years, particularly as it relates to wealth management.
That's a great question. Okay. I will give you my 2-minute answer, guys. This is a 2-minute drill. Okay. Here's what I think. I think that AI is remarkable in lots of ways, but AI at its base is a pattern recognizer. Okay. That's all it's doing. That's all these LLMs, large language models, are doing. Is they're pre-trained transformer models, right? They're just taking really big corpuses of data. Those could be numbers, those could be words, those could be behaviors, and they're trying to learn from those. They're guessing what to do next, given all the patterns that they've seen. God, what is Matt really trying to get at here? Let me try to answer that with this picture or with this word or with this sentence or with what they can kind of go and collect. And so it turns out in lots of cases, that's awesome, right? Because it turns out there are a lot of patterns. This is great, Matt, because you've come full circle. In lots of instances, behaviors are enduring. So what you wanted yesterday, the toothpaste you wanted yesterday is the toothpaste you want today. Where you put your yogurt yesterday is where you want to put it today. Here's the problem. Financial markets, by their construction, are dynamic and innovative. No one knows what's going to happen tomorrow. In fact, if you look at the largest drivers of asset prices, I'll give you the largest driver of asset prices in the last 10 years. It was the health pandemic. Okay, across equities, across debt, across real estate. And why is that so important? Well, literally no AI model could have predicted that. In 2019, it had never happened. There's not a single model you could have trained that would have predicted what was going to happen. Oh, there's going to be a health pandemic. It's going to shut down markets in ways we've never seen. That's not what they're built to do. And yet that's the biggest driver. Whatever President Xi says tomorrow, right? Or Trump or whoever else, that is going to drive markets. Fukushima is going to drive markets. And by definition, AI can't predict that. And so there are some ways in which AI will always have a ceiling in what it can do in terms of wealth management, because those can be big drivers of wealth. And given that those are such big drivers of wealth and AI can't really help us there, there's always going to be need for that human to kind of figure out what to do next, or the human to figure out how to harness AI. That being said, I think humans can harness AI, but I think that's going to leave a lot of space for humans to always be involved in the process.
Professor Cohen, what a wonderful place to leave our chat. Thank you so much for joining me. And as mentioned, we'd love to get you to Australia and look forward to keeping in touch.
Matt, that sounds great. Thank you so much for having me. I really appreciate it. It was a great time.
Thanks for listening to this episode of Between Meetings. For more episodes and to subscribe to our series, visit the NetWealth website, iTunes, Spotify, or your favourite listening service. And if you want to contact me or engage or discuss any of the topics raised, please find me on LinkedIn or Twitter or send me a private message. We hope you can tune into the next episode.